Good morning, everybody. Let's get going. So this week, last week I was moaning there wasn't much news to report. This week there's actually quite a lot. So what I've narrowed it down to is 3 stories in the UK. But I want to get through them so that we can talk to our guest, Nicholas Yeo, who's the manager of the new Aberdeen China Trust that's going to be formed from the merger of Aberdeen UTI and Aberdeen Emerging. So without further ado, it's these are the 3 funds that I want to talk about. So Gresham House Strategic, Castlenau, which is a brand new thing, and Artemis Alpha, as I say, in the UK sectors. Gresham House first. Its performance has actually been pretty reasonable recently, as I'll show you in the tables in a second, and the discounts narrowed a bit too. Here we are here's where it sits within the sector. So it's not particularly big, 61 million market cap. I think it could be bigger than that. But obviously the main constraint to that has been the fact that it's been trading in discount for all of its life. And that's one of the reasons I think why things sort of blew up between the manager and the board, as we'll explain in a second. It's not about yield, it's about generating capital growth, as most of these funds in the UK equity small cap sector are. And the charges, partly because of its size, are actually quite high, as you can see there. And that's probably too high. It's one of the worst in the sector. So in terms of performance, I had to correct the numbers that were Morningstar. I've asked them to correct the numbers that display on our system. And as you can see there, it's towards the top end of the table. And that's really because it's been performing very well over the past year, as we had the bounce back from COVID. And that's particularly true in share price terms. So you can see that the discount has now rattled in quite a lot because the share price return is 80% against 55 for the NAV. This fund started off as Spark Ventures, but back in July 2015, there was a proposal put to the board of Spark Ventures by Gresham House that they wanted to remake it into a new vehicle to do strategic public equity investment, which is the same sort of thing that they were doing with Strategic Venture Capital. It's the same team. And at the time, though, Strategic Venture Capital was being run by a different management house. But a chap called Graham Bird, who was going to run it, had quite a lot of experience of doing this. And the Gresham House agreed to invest some money into both the fund and the management company to get this whole thing over the line. So not really surprising that Spark Ventures board decided this is a good idea. In September 2019, Gresham hired Richard Staveley from Majeddy. So Richard Staveley is an ex-River and Mercantile and quite a good reputation. He took over as the manager in November that year. And everything was sort of fairly hunky-dory for a while. But relations between the manager and the board deteriorated, and it all kind of blew up in May. So remember we talked about this on the show before. In no sort of particular order, it's quite hard to determine what happened first. The board launched a strategic review, served notice on the manager. Richard Staveley left the manager, and Gresham served a requisition to remove the chairman because he'd been on there for 18 years, and they thought that was a problem in terms of trying to raise money from new investors, and then withdrew that after the chairman resigned. So the net outcome of that was that the manager had to be changed within Gresham, and Gresham ran a notice. So the strategic review was kind of rumbling on in the background, and then we finally got some news this week. So Harwood Capital have been appointed as manager, and I think the things that Harwood have thrown into the pot to get this across the line are actually quite generous with it. So the first thing it's done is slash the fee quite a lot. So it's now a tiered fee. That first tier is quite small, only 25 million so they reckon that saves about 270 grand a year in terms of fees. So that's going to make a big difference to that ongoing charges ratio that I showed you before. There's still a performance fee, but it's a bit more challenging. So it's 10% over a 6% hurdle. And provided that the NAVs are 100 million, they've agreed to cap the total fee. That's the base management fee plus the performance fee at 3% per year. They've also offered to buy Gresham House's stake, which is going to be a stumbling block in all of this. It would have been an overhang of stock and kept the discount wide for a long time if they had not done it. And they've also agreed to put more money into the fund. So up to a maximum of earning 29.9% because they don't want to bid for it. They will also buy up to 10% of new shares in the fund. So that would have given it quite a lot of control over the company. And again, as I said, Harwood has been quite good in the way it's done this. It's agreed not to vote more than 10% of those shares at any resolution without the board's approval. So if there's anything contentious, so the board wants to get rid of Harwood, for instance, and wants to put that to a vote, then Harwood won't be able to vote more than 10% of its shares, or 10% of the stock it controls. You know what I'm saying. There'll be no double fee charging, so Harwood won't start charging fees until Gresham's notice period has expired. That was relatively long, so there's a little bit to go on that. But the new notice period on the contract has gone down to 6 months, which I think is much more reasonable, and it's probably where most notice periods should be, I think, in my opinion. The name's going to be changed, not surprisingly. So we will now be Rockwood Strategic. And the crucial thing is that Harwood are hiring Richard Stavely to come and run it again. And he'll be working alongside the existing teams at Harwood. So they already run quite a lot of money in this sort of style. So £1.3 billion in trusts. So that most of that is North American smaller companies, which has got a great record, but a massive discount. Oris International Growth, which has also got a good record, and the discounts narrowed quite well. And Odyssean, which is run by the ex-manager of Strategic Equity Capital, and that's actually trading on a premium at the moment. So they've also got about another $1 billion of assets under management. So all in all, I think this is probably quite a good move for Gresham House Strategic. Everybody comes out of it reasonably okay, so Gresham House get compensated. The shareholders end up with the same sort of team doing the same sort of thing. So I think they're probably quite good tick in the box. We'll see what happens next. Castlenau is a new issue that got across the line this week. So it raised £53 million of new money, and it's also got a seed portfolio that it's rolling in that was held by existing clients of the manager. So that gives it a starting market cap of about 178 million. It'll start trading on Monday on the specialist fund segment. So it's a bit more awkward for retail investors to invest in, as we know, with these things. I think it's because of the concentrated portfolio. You know, I don't like this, but there's not much we can do about it. It's going to be run by Phoenix Asset Management, a chap called Gary Channon, who you might know because he also runs Aurora Investment Trust. And that they've got other money besides doing the same sort of strategy. They had a big sort of backer who raised a big chunk of that 53 million. So Peter Wood, who's ex-Direct Line and Go Compare, he put in 25 million pounds of that, which is quite a good vote of confidence, I guess. It's going to target 10 to 15% more than the return on the all share and a minimum NAV total return 20% a year. I think that's completely ridiculous, to be honest. I don't think that's achievable. If it does, amazing, but I'd have that as a target, I just think is a bit daft. There won't be an annual management fee. So it's the basis of their return is that they'll get paid if they earn a performance fee. And the performance fee is quite chunky as a result. So it's a third of all of the outperformance of the all-share index over a 3-year period. Those sort of performance fee-driven fee structures are okay. It seems to be working quite well at Shaker India Equity, actually. So, yeah, all well and good. You know, I don't have a problem with performance fees that are properly structured. A third is quite high of all returns, but obviously that's offset by the fact there's no management fee on a kind of base basis. So we'll see what will happen, but it's going to start off with a portfolio of 6 companies. And really the strategy is to get heavily involved with these and the management and the running of these companies and add value that way. So they've got a couple of unlisted things, Rawnet and Ocular, and then Dignity, which is the funerals business, Hornby, as we know from the model trains, Stanley Gibbons, stamp collecting thing, and Cambium Group, which is a wedding gift list company. So good luck to it, and we'll see how it goes. But I don't think we're going to be seeing the sort of returns they're holding out for. Now, if you just go back to, actually, we go forward, sorry. We're going to talk about Artemis Alpha next, but I just wanted to point out the returns on Aurora. So it's been doing almost 10% a year over 5 years, 7.6 over 3 years, down towards the bottom end of its peer group. I think to say that you're going to do 10 to 15% above the all share is just a bit of a pipe dream, but we'll see how we go. Artemis Alpha. This was, to be fair, a bit of a dog, but it's had much better performance in recent months and I suppose over the past year. That's helped the discount narrow, which is obviously a great thing. I've put the returns all the way back there to 2012 because it's quite important, because we're going to talk about what happened in 2016 in a second. It's not very big in the context of this. We haven't got the same problem in the UK. UK small cap, I just think there's too many funds now. UK all cap, it's not quite the same thing, but it is small within this peer group. The discount, as I've said, is reasonable now, single figure, just which I suppose is good. Again, it's not run for yield, and the ongoing charges, although they're relatively high within this group, they're not outrageous, 0.93. Here's the returns. So as I said, even though that it's come back up again recently, it's still not looking great against that peer group, because we had some quite stonking returns within that, things like Fidelity and Henderson Opportunities. Now, this is the sort of history of it. So back in 2016, after that period of quite poor performance, the board said, okay, well, we've got to do something about this. One thing we're going to do is cut the exposure to unquoteds, which were 27.3% portfolio down to less than 10%. Now, this is interesting because we're going back now, that now the idea of managers running listed equity portfolios, including quoted companies within them, is all the rage, because Bailey Gifford are doing it and doing it successfully. But back then, this was all going to be a bit of a disaster, and so shareholders were clamouring to reverse that decision, which shows the swings in sentiment we get in the sector. But so the board said, well, okay, we're going to cut the exposure on quoted to less than 10%, and we'll also hold a continuation vote in October 18. So kind of kicking the can down the road, give us another couple of years, let's see how it goes. If everything's okay, you'll vote for continuation, and I think will be great. Come May 2018, they said, okay, what we're going to do now is we're going to change the investment objective policy, and rather than having a continuation resolution at this meeting in October, let's have triennial liquidity events. But so every 3 years, we'll offer you a chance to get some money out. But we won't start that now. We'll do it in 2021. So we'll give you, in 2021, we'll give you a 25% tender offer at a 3% discount. And that sort of kicked the can down the road again. So from 2016, we've now extended out to 2021. October 2021, we've got a great new idea now. We're going to suspend the tender, and instead of doing that, we're going to buy back shares. So we're going to do that over the next 3 years before the AGM in 2024, and we'll try and get the discount down to 3%. And then we'll still offer you a tender offer in 2024. Now, this continual kicking the can down the road thing is a bit cheeky, I think, but they have at least now said, well, we won't do it unless shareholders say this is okay. So I think actually shareholders might say, yes, this is okay. Because if they're serious about the buybacks and they're serious about trying to drive the discount down to 3% or less, that could have the desired effect quite quickly. We'll have to wait and see. Couple that with the sort of improvement in performance, as long as they can sustain that, it may be that they can get the discount down into quite a small number. And what they would obviously quite like to do is issue some stock and grow the fund. So we'll have to wait and see whether that happens or not. But my inkling is that shareholders would say, yeah, this is okay. Yeah, we'll watch this space. So that's enough from me.